Today's class we are going to be looking at IS2 inventories, and just like previous classes we already know the modus operandi of our lessons. And one of the first things we do is that we give the objectives or the areas of focus in the class first, and we've highlighted the areas of focus down here in our notes. Then we move over to the notes and calculations. If there are calculations, then that's the end of the class after that. So we'll quickly move over to the areas where we'll focus on. And here we have the definition, which is usually the first in any topic. You would have to define what the topic says, what it's all about, so we'll be able to understand better. And the second is the measurement of inventories. The third will be cost formulas in inventories. What formulas do we use in inventory? The fourth would be formulas. Now the formulas are still related to the cost formulas in inventory. We'll be taking a look at them. Then disclosure requirements in IS2. Then we'll quickly go over to the first part, which is the definition of inventories. And now IS2 gives us three areas where inventory covers. Now relating to its definition, and it goes here that inventory is assets held for sale. Now held for sale as our normal stock, our normal goods, like traders selling stock in trade, or finished goods. It could be a car, an automobile if you sell cars. It could be a shoe, it could be clothes, it could be anything you sell. That is your stock, which is held for sale. That is one. And we should take note that it is called inventories now, not stock again, according to IAS standards. So the first one is that it is held for sale. That's clothes, shoes, bags, anything. If you deal with accessories, you'd have wristwatches, as long as it is held for sale for the purpose of that business. Then the second one is assets in the process of production for sale. Now, for people or for companies or for organizations that manufacture their goods, they have um materials in the process of conversion. They are not done with converting it yet, it's still in the machine, but we classify that as an inventory in IS2. And one of the common name for that class of inventory is called work in progress, WIP. Assets held for sale, the first one. Assets in the process of production for sale, that's work in progress. Then assets in form of raw materials or supplies to be used in the production process. Now we have held for sale, we have process of production for sale, then we have raw materials. In other words, we have finished goods, we have work in progress, then we have raw materials, the three of them. It comes from raw materials, then it is gradually converted, and the process of conversion, it turns into work in progress, then finally finished good. These three stages are classified. When an item is in these three stages, they are classified as inventory. So now we should not forget that the three of them have something in common, and that is for sale. The aim of inventory is for sale, not for use by the business, which distinguishes the inventory from your PPE, property, plants and equipment. Property, plants and equipment is used by the business to generate more income, while inventories is sold off. So we are done with the three definitions given, the three areas of the definition. They are not three definitions now. The three of them are in one, just like three in one, not three separate together. When you are giving the definition of inventories, you give the three of them together. Then we'll move over to the measurement of inventories. It says inventory measurement is very important because it affects two areas. Now, inventory affects two areas in our financial statements. Our financial statements are records of financial transactions of the business. Now, it is usually presented once a year. You can have it quarterly, you can have it half um half of the year, you can have it once a year, as I've said before. So now inventory measurement is very important because it affects two areas. Now we are going to look at the two areas where it affects in our financial statements. Financial statements are presented to shareholders by the managers of the company. So we have, it affects the cost of sales. Now the cost of sales is in the income statement. Remember um we did statements. Now the financial statement comprises of several statements. That's why it's in plural. So we are not into that now, but we are going to look at the area where cost of sales is, and it is in the income statement or statement of comprehensive income, which is one of the financial statements to be presented that is mandated by IAS. The second here is the total asset value. So I skipped something in the first one. The first one, cost of sales, and once it affects cost of sales, obviously cost of sales is an expense. It would reduce your profit. If it increases in cost of sales, it would reduce the amount you can have as profit. If it increases expense, it would reduce the amount you can get as profit. While if it reduces cost of sales, which is an expense, it would increase the amount you can have as profit at the end of the period. Then all these are disclosed in the income statement. Then the second is the total asset value. Now, inventory is an asset, that is quite common, and assets are presented in the statement of financial position. So if you have an increase in assets, obviously increase in inventory, rather obviously your asset value would increase, and a decrease in inventory will cause a decrease in your asset value. And these are the two areas inventory affects. So the measurement of inventory is very important because it affects two accounts, two out of the mandated five by IAS. So two is very significant when preparing statements. So inventory is very significant. To get the measurement is very significant. Then he said after all this we should ask ourselves these questions before valuing the inventory. Now, when you'd want to value an inventory as a novice, you could ask yourself some questions like, should the inventory be measured at cost? Now, that is the cost I use to acquire the product as a trader or a business man or woman. Acquiring an inventory and recording it at cost, the cost you use to acquire. If you are a dealer in accessories, I buy this wristwatch for say $200, I record it at cost, at the cost of the inventory, the value of the inventory, that's the wristwatch, is $200. That's just a fictitious figure. So should the inventory be measured at cost? The cost I use to acquire the products, also if it's a shirt, anything you deal in, accessories, food items, stock, anything you deal in, the cost you use to acquire it, should you record it at that cost as the value of the inventory? That's one question you should ask yourself as a businessman or woman. And the next you'd ask yourself is, which expense should I, if I'm recording it as a cost, now which of the expenses I have incurred on that product should I use? Now, you could see that there are several or so many expenses you could have when you'd want to buy a product. I'll give you an example of buying a shirt to sell. If you want to get a shirt to sell, you'd have to obviously go to the market. If you are going there, collect the shirts, you pay transport fare, you pay for the shirt itself, you pay whatever tax you need to pay on the shirt if there are taxes by the government. Then you go back home or you go back to your business area. Those processes involve expenses that need to occur for you to get that shirt to sell. Now the question is, should I include the tax amount as the cost of inventory, the cost of the shirt? Should I also include my transport fare as the cost of the shirt itself when I want to sell or when I want to record the value of the inventory? Now we'll be knowing that very soon. And it said when it's hard, the third question you ask yourself is that when it's hard to determine my costs to acquire the inventory, what do I do? Now, if it's hard to determine the costs, what should you do? That's another question a novice should ask. Now we'll go to the measurement rule on inventory, and it says IS2 says it, that is inventory, must be measured at lower. Now, how do we measure inventory? How do we measure the shirt I bought at the market? What value do I give to it to be true, to represent a true value of the inventory I bought? It says IS2 says it, that is the inventory, must be measured. Now, the emphasis on must, that means there are no other options. Be measured at lower of the first is your cost. Now, IS2 says pick one of these, and when you are picking one of these, you pick the lower of them. Lower has been highlighted in the notes here. Either you pick the cost, the lower, whichever is lower between the cost, as cost used in acquiring the inventory, goods, stock, clothes, shirts, whatever you sell, bags, food items, or the net realizable value. Now we'll be taking a look at the definition of net realizable value down the line, but let's go slowly till we get there. So IS2 says pick one, cost, net realizable value, and when you're picking one, you pick the lowest. Now, what is cost? What is cost of the cost of inventory, or what is included in the cost of inventory? Like I gave the scenario of the shirt, where I go to the market, I spend transport, I spend on tax on the shirt, and I spend on, say, transport to come back again. So how do I record it as the value of the inventory? Do I record those expenses or should I not record those expenses? So it says IS2 instructs we comprise this cost of, that's the cost of inventory. Now when you're using the cost method, you comprise it of, the first is the purchase, that's the purchase cost, and the purchase cost is how much you actually bought the shirt in the market. If I bought it for $100 or 100 naira, obviously there's no shirt 100 naira now. Say, so let me use $100. $100, that cost of the shirt I used to buy the shirt should be recorded as part, not the full cost, but part of the cost of the inventory. Then also conversion cost. If I'm to process the shirt into something else or add some features to it, then I would add the cost to my new inventory, since I'm no longer bringing a regular shirt but a rebranded one. Then also other costs incurred in bringing the inventory to its present first location, then condition. Now location, carriage inwards, that is the transport. Without going to the market and transporting the shirt to my office, the the shirt won't be with me. I won't be the owner of the shirt. It had to be done. It was compulsory for that transportation to take place for me to have the shirt as my inventory. So it is also added to the cost of inventories. So we have the purchase cost, conversion cost, and other costs incurred in bringing the inventory to its present location and condition. So those are the three there. And you know the third one is very broad. It could encompass several different costs that I've mentioned previously. Now we'll go down the purchase cost. What is included in the purchase cost? Now we have the purchase price. It's part of the purchase cost. That's the $100 shirt I bought is the purchase price. Then your import duty. Now this category is paid to the government. It's compulsory, not the word compulsory, and it is paid to the government here. Import duties and non-recoverable taxes. So that tax I paid on the shirt, if it's non-recoverable, I should add it to the cost of the shirt. I should add it to the cost of the inventories rather, that I would use to record as in my books rather. I would add the import duties, I would add the non-recoverable taxes, and also the purchase price, the $100. So if the non-recoverable tax on the shirt is say 10%, I'll have 10% of $100, that's $10. Then will be added to the $100 to give me $110 as part of the shirt's cost, part of the inventory cost now. Then transportation, transport, handling, and other costs directly attributable to the purchase. As we've said below, the transport that is compulsory to take place, compulsory. Without it, the shirt would not be with me and it will not be called my inventory. That part of the cost is added to the cost of the inventory itself. So then we have conversion cost. Now we had conversion cost down here as the second one. So we are going to be looking at what part takes or what comprises of conversion cost. We had purchase cost, we have the purchase price, import duties, non-recoverable taxes, and transport. We should write this down. Then conversion cost, it's usually for manufacturers, people who produce, people who process have conversion cost. Now this cost also adds to the purchase cost previously mentioned to make up the cost of WIP, that's work in progress or finished goods, if it has been completed. That's finished goods if it has been completed. You add this cost to the cost of WIP or finished goods if that's finished good now if the goods have been completed. Conversion cost consists of now costs directly related to each unit of production as direct costs. We all know these: fixed overheads, variable overheads, fixed overheads, static. No matter the amount of units produced, the cost is static, the same. It only changes like once in a long while. Then variable overhead changes more frequently with the number of units produced. Those are costs that change more frequently with the number of units produced. Now, other costs incurred in bringing the inventory to its present location and condition. This part of the cost is usually occurring. It occurred in our purchase cost, now it's occurring in our conversion cost. So that's just a hint that once you don't know anything related to that one when writing your exam, you can quickly scribble that down as part of it. So production overheads include indirect labor costs, salaries of factory managers and factory supervisors, depreciation costs on non-current assets used in production, then carriage inwards. Now we have something to note here. It says admin, selling, and distribution costs are not included in cost of inventory. Now these are not compulsory for acquiring the inventory, admin cost is not compulsory to acquire. Selling and administration is compulsory to sell but not to acquire the inventory itself. So it is not part of the cost of the inventory. Then it says the process of allocating cost to units of production is usually referred to as absorption. Now that will be treated later, but the term should be noted. Absorption. Absorption is done by linking total production overheads to production variables like time, wage, material. What is basically trying to say is trying to divide the overheads by these factors to get the cost per factor like this. That's in simple explanation now. So cost formulas for inventory. We are going to be moving over to, I think, the third one, the third area of concentration, which is cost formulas for inventory. Now we have formulas here. Okay, now people normally confuse the cost formulas with this. That is the trying to get it with this, the measurement rule. Now the measurement rule, from what I've read is that the measurement rule is basically the general measurement. The general, okay, I'm buying 200 shirts. So how do I measure these 200 shirts now? I'm buying them in bulk. Now bulk is the term to be noted. How do I measure if I buy 200 shirts? How do I measure them in bulk? If I buy 200 shirts at, let's say, 200 or $100 each, so we have about $20,000 for the 200 shirts. That's measuring it at cost. It's a bulk thing for the measurement rule cost, while this, which is the cost formulas, try to get the unit value for each one of them. Each unit, how much do I price my inventory? How much do I put as the price of my inventory? And the first way you could do that for each unit is by using first in first out, that is FIFO. Now IS2 has recognized only two right now. The first is FIFO, the second is AFCO or WAC, weighted average cost. And we'll be taking a look at the first one, which is FIFO. It says FIFO assumes inventory is consumed, that is sold, in the strict order to which it was purchased or manufactured. That's the first one purchased or manufactured is the first to be sold. The first items that are received are the first that go out, just like the name, first in, the first to go out. So we would note the following when we are trying to solve issues relating to first in, first out. Basic thing is that you should note the following, keep note of the following, and keep track of them. The first is the date. That's the date of any purchase that's bought, the date of any issue, that's sales, the units bought at any date, the units issued at any date, then their price. Those are the five basic things we need to master. Then it's pretty simple to solve questions relating to the first in, first out. And it says with this, it is possible to get the value of inventory already sold. By getting the unit you sell, you get the value of the inventory already sold. Then you can also get the balance of the remaining inventory. How much inventory in value now do you have in naira terms, or in dollar terms, or in Canadian dollar terms do you have now? And it says here inventory at any time is the cost of the most recent price of inventory. The second is WAC or AVCO, and WAC is weighted average. Sorry, it's supposed to be weighted average cost, not weighted average cost of capital. And the first time when I heard weighted average cost, I was really scared of the name weighted because it sounded really weird from average that I knew. But I basically found out that it's the same thing. The weighted term is not to scale, it's simply using average. Average is dividing total by the number at any point. So we have it here as it assumes that all units are issued at the current, let me skip the weighted, average cost per unit. Average cost per unit. So average total cost divided by the number of units. A new average is calculated on every receipt or purchase only when there's a new receipt or purchase do you calculate a new average, because when there's a sale the average doesn't change. If you'd perform some computations there, it doesn't change. Only when there's a new receipt at a different value does the average change. Now we have the formula here. It says cost of inventory in store currently plus cost of new inventory received, as inventory old, inventory new, divided by the number of units in store, number old, number of units new that's received. So inventory old plus inventory new divided by number of units old plus number of units new. That's our weighted average. It's basically average. The average of your inventory divided by the number of units. The cost of your inventory, cost divided by units. It's average. Forget the name weighted there. So we have now, we are moving over to the net realizable value. And it says net realizable value is the estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost necessary to make sales. Now, net, when your cost is hard to determine, or it's not really clear how much you spent on it, if you can't measure at cost, you have the option of measuring at net realizable value, but you have to value the cost first and the net realizable value and pick whichever is lower. So when the cost is not really clear though, you have the option of the net realizable value method. And the net realizable value method is simply how much you expect that the shirt you bought will be sold in the ordinary course of business. It means not to your friends, that's related people, partners that you can reduce the price for, to someone who is a distant party, then less any cost of completion, that's if you are processing it, and estimated costs necessary to make sales. Any cost that must be incurred to make that sales, you less it. So it's basically how much you expect that you would get, or these clothes, the shirt, the inventory will be sold for. And it says it is the amount, another definition here, it is the amount that can be obtained from selling the inventory in the normal course of business, not to your friend, not to your brother, not to your sister. And you can reduce the price. Okay, give me 50%, give me 3 over 4 of the price, less any further cost that will be incurred getting it ready for sale or disposal. And we have points to note here. NRV is usually higher than cost, therefore inventory is most times measured at cost. Now NRV obviously has a margin on top that you would get as profit or gain from selling your product, or that anybody would expect to get as gain from selling his product on the cost of the item. So most times NRV used to be higher than cost, and NRV is net realizable value. The amount I expect to sell the shirt I bought, 100 naira or $100, should not also be $100. At least I'll get something, let's say $110 or $1,100. I mean, sorry, $110. That's a $10 gap, a $10 margin. That would be the amount I would expect to sell it in the market. But sometimes it's not always the case. Sometimes the NRV could be lower. So we'll look at why the NRV could be lower than the cost. And when it is lower, as required by IS2, you'd use NRV to value your inventory, the lowest to value your inventory. And it says, however, when inventory loses value, now this is when NRV becomes lower than cost. There, that should be there. The damage value, or being damaged or being obsolete, net realizable value will become less than cost. Now, it has when it loses value by being damaged or being obsolete. When the product is damaged, now the shirt has been soiled by oil or grease, you don't expect anybody to buy that shirt again 100 naira. So you'd say, okay, for this shirt that has been stained, just give me $50 on it. Now the amount you expect to recover from that shirt is $50, which is lower than your cost. What you should do is to value your inventory, the shirt, at that $50, since it has become damaged in quotes now. It's no longer appeasing to people. So, or obsolete, then net realizable value will become less than cost. So I've given an example, and it says cost and net realizable value should be compared for each separately identifiable item of inventory or group of inventories. So for if you're selling shirts, shoes, bags, you don't just calculate it for the general shirt, shoes, and bags together, put everything together. You do for shirts, you do for shoes, you do for bags, then you get the lower of NRV and cost for each one of them. Then it also says NRV is lower than cost when we said these goods are damaged, goods are wholly or partially obsolete, selling prices have declined. So we have an example here. Example on purchase cost, how to get the purchase cost, and we gave um areas where purchase cost covers, what comprises of purchase cost. So it says Kaduna Consumer Electronics, and this example was gotten from Icon Old Study Park. It says Kaduna Consumer Electrics, rather KCE, buys goods from an overseas supplier. It has recently taken delivery of 1,000 units of component X. The quoted price of component X was 1,200 per unit, but KCE, as a company now, has negotiated a trade discount of 5% due to the size of the order. So we have a trade discount, we have the purchase price of 1,200. We should be writing this down. Then the supplier offers an early settlement discount of 2%. Now, trade discounts, then we have cash discounts, what we call cash discounts. Trade discounts, bulk purchase, cash discounts, early settlement of payments or debts. If you pay early within 30 days, the supplier would give you 2% discount on what KCE buys. So, and it says KCE intends to achieve this. Import duties of 60 naira per unit must, now the word must is there, so we gave import duties as part of the cost, be paid before the goods are released through customs. Once the goods are released through customs, KCE must pay a must again delivery cost of 5,000 naira to have the components taken to its warehouse. So now what would you call the purchase cost? Let's go back to where we gave components of purchase cost, and we gave them somewhere here. Yeah, purchase cost will include the purchase price, import duties, non-recoverable taxes, transport, handling, and other costs. So let's go back to the question here. Yeah, so we have the purchase price here, which is part of the cost. He buys, does the company buys 1,000 units at 1,200 naira per unit. Then there's a discount, and the only discount that is necessary in getting the purchase cost is the trade discount, the bulk buying discount. The cash discount is completely ignored according to IS2 rules. So we have 1,000 units times 1,200 naira per unit, $1,200 per unit. times 95%. Now we've taken away the 5% trade discount. So we have a total figure of 1,140,000 naira. 1,140,000, $1,140,000, $1,140,000 shillings, whatever currency you use. Import duties, we have 1,000 units again times 60 naira per unit. Remember, import duties is part of our cost. We have 60,000. Then the delivery cost, 5,000 naira. So we have the total of 1,205,000 naira, 1,205,000 rubles, 1,205,000 dinars. Whatever currency you use, currency is not a problem here. So that's it. We've taken care of everything here. We should note that the cash discount is ignored. Trade discount is the discount that is used in calculating your purchase price, your purchase cost. It says the intention to take settlement discounts, which is cash discount, is irrelevant. So we settled that. Example 2, a business has 4 items of inventory. A count of the inventory has established that the amount of inventory currently held at cost are as follows. So we have first inventory A1, second A2, third B1, fourth C1. Their costs 8,000 for A1, 14,000 for A2, 16,000 for B1, 6,000 for C1. The sales price 7,800 for A1, 18,000 for A2, 17,000 for B1, 7,500 for C1. Their selling cost 500 A1, 200 A2, 200 B1, and 150 C1. So what we are to get is to get the lower between cost and net realizable value, which is lower, to get how we should price each category of our inventory. Now A1 could be shoes, A2 could be food items, A3 could be automobiles, that's motor cars, vehicles. Then C1 could be, let's say, water bottles, whatever we're dealing. So NRV, remember, NRV is the expected selling price less any expected cost of completion or cost necessary to be made for the sale. And now we have the selling cost here and we have the selling price here. Cost is direct, so which is lower? So for A1, 8,000 or 7,800 minus 500. Remember, the less selling price, less selling cost. So which is lower, 7,300 or 8,000? We have 7,300 for A1. So A1 is valued at 7,300. A2, which is lower, 14,000 or 18,000 minus, that should be 4,000. Rather, the selling cost should be 4,000. Okay, whichever way, there's a typo. So it says 18,000 minus 4,000 would give us 14,000. Yes, no, it's not a typo, sorry. 18,000 less 200 would give us 17,800. And now we are looking for the lower of 14,000 and 17,800, and the lower is 14,000. Although the zeros are not complete there, but it is 14,000. Then inventory B1, we have 16,000 or 17,000 less 200. Here it gave us the root 500 here, so let's just go with the one here. 17,800 less 500, so we have 17,300 or 16,000, which is lower. We have 16,000 as lower. And C1, we have 6,000 or 7,000 minus 200, so 6,000 is lower than the result of 7,200, which is 6,800. So the total lower figures would have 43,300 as our total inventory value. Now, why IAS uses the lower value is so we would not overestimate our business capacity. Will not. It's better to put a conservative figure than to overblow the figure, then everything crumbles at the end. So that's why IS2 feels it's safer for you to value assets or your inventory at the lower figure of whatever type of measurements they require you to use. Now we have accounting for a write down. Now there's a write down when net realizable value is less than cost. And you know, when net realizable value is less than cost, you use net realizable value to value your assets or your inventory. So you'd debit cost of sales and you credit inventory. And you know, when you're crediting inventory, you are lessened from the inventory because the inventory is an asset, and assets are supposed to be debited to be increased and credited to be reduced. Now, cost of sales is an expense, and expenses are supposed to be debited to be increased and credited to be reduced. Now we are using DISU: debit, assets and expense, credit, income and liability. That is the whole trust of accounting. DISU: debit, expense and assets, credit, income and liability. Then the disclosures we'd have here. IS2 requires we disclose the following: accounting policy adopted, that's the cost or net realizable value (NRV), total carrying amount of inventory, finished goods value, work in progress, raw materials value, the amount of inventory carried at net realizable value, the amount of inventory written down in value, that is expensed in the period. Now an example is this: you debit it, that means expense it. That means okay, it has gone down, the value has gone down, so we wasted the money. Example is the shirt, the $100 shirt sold for $50. So we wasted the $50 because the oil or the grease stained the clothes. So you expense it, it's now an expense. Then the we have details of any known circumstance that may have led to the write down, then the amount of any reversal of write down. If there's a reversal of any write down, say the buyer says, hey, okay, this shirt is still good, okay, rather than give you $50, I'll give you $70, although this is rare but it could still happen. Then the final one is circumstance or events that led to a reversal of write down. So that takes us to the end of today's class. I hope we enjoyed it and wait for the next class. Thank you.